Ever wondered how you can have a piece of the biggest companies in the world? Well, that's where large company stocks come into play. These are shares issued by the world's most successful and influential companies. By purchasing these stocks, you effectively become a part owner of these companies, albeit on a very small scale. Large company stocks, often referred to as blue-chip stocks, are widely regarded for their stability and reliability. These are companies with a proven track record, and they're known for their ability to weather economic downturns. They tend to offer regular dividends, providing a consistent income stream for investors. And here's the cherry on top. Despite their size and stability, these stocks still have the potential for growth. These companies are continuously innovating and expanding their reach, which can lead to increased profits and consequently, higher stock prices. Now that you understand what large company stocks are, let's delve into how you can assess their value. Fundamental analysis. Sounds complex, doesn't it? It doesn't have to be. At its core, fundamental analysis is all about understanding the intrinsic value of a company. It's like peeling an onion layer by layer to reveal the heart of the matter. And in our case, the heart is the real, inherent worth of a business. So how do we peel this onion? We start by looking at the financial health of the company. This includes studying the company's financial statements, such as the balance sheet, income statement, and cash flow statement. These documents are a goldmine of information. They tell us about a company's assets and liabilities, its revenues and expenses, and how much cash it's generating. But we don't stop there. We also need to understand the trends in the company's industry. Is the industry growing or shrinking? What are the key challenges and opportunities? Who are the main competitors and how does our company stack up against them? These factors can significantly impact a company's future prospects. And finally, we need to consider broader economic indicators. These are the big picture factors that affect all businesses, like interest rates, inflation, and GDP growth. For example, if interest rates are high, it's more expensive for companies to borrow money, which can squeeze their profits. On the other hand, if the economy is booming, businesses are likely to thrive. Now remember, the goal of fundamental analysis is not to predict short-term stock prices, it's to understand the underlying value of a company, so we can make informed long-term investment decisions. It's about buying a piece of a business, not just a stock. So there you have it. That's the essence of fundamental analysis. It's a systematic approach to understanding a company's value by digging into its financials, industry trends, and the broader economy. It's not about chasing hot stocks or trying to time the market. It's about investing with knowledge, patience, and discipline. Fundamental analysis is the bedrock of smart investment decisions. But how exactly do we use it to value stocks? Scene script. Ever heard of the term price-to-earnings ratio? That's one of the valuation methods we use in fundamental analysis. So let's dive into it. The price-to-earnings ratio, or PE ratio for short, is a simple tool that tells us how much investors are willing to pay for each dollar of a company's earnings. It's a snapshot of investor sentiment, showing us the value the market places on a dollar of earnings. Imagine you're at an auction. The PE ratio is like that little tag on the antique vase you're eyeing. It's the price tag of the earnings of a company, and investors are the bidders. The higher the PE ratio, the more they're willing to pay for that dollar of earnings. Now, you're probably thinking, okay, that sounds great, but how do I calculate it? Well, it's as easy as pie. You divide the market value per share, that's the price of one share of stock, by the earnings per share. Suppose the price of one share is $50 and the company's earnings per share is $5. The PE ratio would be 10, so investors are willing to pay $10 for each dollar of earnings. Now, what does this mean for you as an investor? Simply put, a high PE ratio could mean that the stock is overpriced, or it could indicate that investors expect high earnings growth in the future. Conversely, a low PE ratio might suggest that the stock is a bargain, but it could also mean that the company's earnings are expected to grow slowly, if at all. It's a bit like Goldilocks porridge, not too hot, not too cold, but just right. You're looking for a PE ratio that gives you the best value for your investment. Remember, the PE ratio is just one tool among many in the world of fundamental analysis. It's not a crystal ball, but it can give you a good sense of whether a stock is overvalued or undervalued. The PE ratio is a simple yet powerful tool in our arsenal, but it's not the only one. Let's dive into another key valuation method, the price-to-book ratio. This valuation method, often abbreviated as PB ratio, is a financial metric that is used to compare a company's market value, That is the price at which its shares are trading for on the open market, to its book value, which is the value of the company according to its financial statements. Now, how do we calculate this P/B ratio? It's simple. You divide the company's current market price per share by its book value per share. The book value per share, in turn, is calculated by taking the company's total book value and dividing it by the number of outstanding shares. So what does the P/B ratio tell us? Well, it gives us an idea of whether we're paying too much for what would be left if the company went bankrupt immediately. If the P/B ratio is less than 1, it means that the market price is less than the book value. This could indicate that the stock is undervalued, or the company is not doing well and is seen as a risky investment. On the other hand, a P/B ratio greater than 1 suggests that the stock is overvalued or the company is doing well and is seen as a less risky investment. But remember, just like any other ratio, the P/B ratio is not a standalone indicator of a company's financial health. It's just one tool in the toolbox of fundamental analysis. It should be used in conjunction with other valuation methods to paint a more complete picture of a company's financial situation. In conclusion, the P/B ratio is a quick and easy way to assess a company's market value relative to its book value. By comparing these two figures, you can gain insight into whether a stock is potentially overpriced or underpriced. With the PE and P/B ratios, you're well on your way to mastering fundamental analysis. So, we've covered a lot today, haven't we? Let's recap. In the world of investing, large company stocks have proven to be a reliable and potentially profitable choice. Companies with a significant market presence often offer stability and consistent returns. They are less prone to the volatility that can sometimes shake smaller firms, and they often come with the added benefit of regular dividend payments. These giants of industry have demonstrated their ability to weather economic storms, and investing in them can be a way to anchor your portfolio in solidity. Next, we dove into the realm of fundamental analysis. This is the process of examining a company's fundamentals, its financial health, its position in the industry, and the economic environment in which it operates. It's about looking beyond the stock's current price and digging into what the company is really worth. By assessing factors like earnings, revenue, and cash flow, as well as broader economic indicators, we can gain a clearer picture of a company's true value. We looked at how fundamental analysis can be a useful tool for identifying overpriced or underpriced stocks. If a company's intrinsic value based on its fundamentals is higher than its current market price, it could be an investment opportunity. Conversely, if the market price is higher than the intrinsic value, it might be overpriced, and investors should proceed with caution. In our exploration of valuation methods, we focused on two key ratios: the price to earnings, or PE ratio, and the price to book, or PB ratio. The PE ratio compares a company's current market price to its earnings per share. A high PE ratio might suggest that the stock is overpriced, or it could indicate that investors are expecting high growth in the future. The PB ratio, on the other hand, compares a company's market price to its book value or its net assets. This ratio can give us insight into how much we're paying for each dollar of net assets. These valuation methods, when combined with a thorough fundamental analysis, can provide a comprehensive view of a company's financial health and potential for growth. They help us make informed decisions and reduce the risk of making poor investment choices based on speculation or market hype. But remember, investing is not a game of chance. It's a strategic endeavor that requires patience, diligence, and a solid understanding of financial fundamentals. Investing in large company stocks, armed with the insights provided by fundamental analysis and valuation methods, can be a rewarding journey towards financial growth and stability. Remember, investing is not a sprint but a marathon. With fundamental analysis, you're equipped to run the distance. Happy investing!